Welcome back. So we've talked so far about what is a recession and what are the various factors that might cause recessions. So today we're going to move on to the question, what do we do about recessions? So we know so far that recessions are caused by falls in the volume of spending when prices are sticky. So prices in general are going to be too high. And by the same token, in a boom, prices are going to be too low. Right? The volume of spending has risen, but prices have not yet. And so in the case of a recession, real output is going to be diminished until prices fall. And then prices falling are going to make it possible for people to be able to make the purchases that they were planning on making with lower prices then. But that's not going to happen until prices fall. Now this kind of implies that deflation is going to be the only cure for recessions. As a matter of fact, there are really two options. Right? We could wait for deflation to work its way through the system. We could try to make prices as non-sticky as possible. But alternatively, we could raise the volume of spending back to where it was so that prices don't have to fall. And this is going to be the goal of two tools that we're going to talk about today. Right, so the goal of these two tools is going to be to stabilize the volume of spending. Right, we don't want the volume of spending to be rising or falling or doing anything too crazy, because that's going to force prices in general to rise or to fall. And that's going to not only cause recessions and booms and misallocations that way, but it's also going to cause people to change prices for reasons that don't really reflect underlying demand conditions. Right? So the less of that we can do, the better. And so during a boom, we're going to want to know how to lower the volume of spending. During a recession, we're going to want to know how to raise the volume of spending. And the goal in both cases is going to be to avoid the necessity of prices having to rise or fall. Right? We're not going to do like Hoover and say that it's illegal for prices to fall, or that we're going to try to convince businesses not to cut prices. Right? Instead, what we're going to want to do is to adjust the volume of spending such that companies won't have to cut prices. And the two tools that we're going to talk about today are, first of all, monetary policy, and second of all, fiscal policy. So let's start with monetary policy. Monetary policy in its basic form is just the adjustment of the money supply by the central bank. And the central bank, if you'll remember, has direct control over the M0 money supply. Right? That's really all the central bank can do directly. However, we talked last time about the determinants of the quantity of bank money, and the size of M0 is one of those determinants. So the more things there are in the economy in terms of which promises can be made, the more of those promises can be made. Right? So if M0 expands, this is going to give banks more ability to expand M2 as well. Right? So the central bank also has indirect control over broader monetary aggregates like M2. Right? So if the central bank expands M0, banks become more liquid, they have more reserves, and they're able to issue more promises of their own. If the central bank cuts M0, then banks are going to have fewer reserves, and they're going to have to cut back on the promises that they make. Now, the goal of monetary policy is to affect the volume of spending, and ideally you'd want to do this so that it stabilizes it. In practice, sometimes that works out, sometimes it doesn't. We'll talk more about that later. But let's talk about the nitty-gritty of how exactly the central bank is going to accomplish this. And we've kind of alluded to this a little bit earlier, but we're going to spend a little bit more time on it now. Right, so the way that the central bank adjusts the supply of money is through something called open market operations. And they're called open market operations because the Fed makes a purchase on the open market. Right? It's not forcing anybody to do anything. It's either issuing or contracting the money supply by making purchases just like you or I might do as well, except that the Fed has the power to issue money or destroy money. So the market it deals in is generally going to be the market for treasury bonds. Right? And the way that it expands the money supply is going to be by buying treasury bonds from banks. Right? So when the government issues debt, it gives an IOU to banks, and banks hold some of those. And then the Fed is going to be able to go in and pay for those from the banks and pay for those with new money. And that's how money enters the economy from the Federal Reserve, right, through the banking system. And the banking system then distributes it via loans or via their own promises to the rest of the economy. And in reverse, right, the Fed's going to decrease the money supply if it ever needs to by selling bonds. And it's going to sell these at the market rate, right? It's not forcing anybody to do anything. But whatever the going rate for bonds is, it's going to sell some. And banks are going to be willing to pay some price for those bonds. And the Fed's going to then destroy that money, or at least sequester it. And that's how the money supply decreases. So here's a diagram about how open market operations work. You have expansionary operations on the left and contractionary operations on the right. And where it says control recession and control inflation, these are examples of why a central bank might want to engage in expansion or contraction, respectively. Right? So if the volume of spending is too high, based on the price level, and prices haven't caught up to the volume of spending, we're getting inflation. Right? And the central bank might want to cut the volume of spending. So what it does is it sells bonds, takes in money, and that's going to decrease the amount of money available to banks. So M2 is going to contract as well. On the other hand, if the volume of spending is too low for the price level, if prices need to fall but they haven't yet, we're going to be in a recession. So banks are going to buy bonds, pay for those with new money, and that's going to ideally increase M2 as well. So when the central bank does open market operations, what it's trying to do is to move the volume of spending, to move aggregate demand more in line with the price level, so that prices don't have to either rise or fall. Now, a lot of times when you read the financial news, or when you hear the Federal Reserve talk about monetary policy, very often they'll talk about it in terms of interest rates. Now, where do interest rates come in? Right? This is actually kind of misleading, because interest rates are pretty secondary to how this process works. Right? Interest rates come in not because interest rates being higher or lower are stimulative or contractionary in themselves. Right? Kind of a secondary effect there, but the main effect is going to be on the volume of spending. So where do interest rates come in? Right? The most important thing for the central bank is going to be the quantity of broad money. Because again, that's going to be what you or I are going to think of when we're making our plans for our spending decisions. But the central bank doesn't have direct control over M2. And so especially when the money multiplier is not constant, when the demand for money is changing and that ratio between M0 and M2 is changing, the central bank's going to need to know how much does it need to increase M0 in order to get a certain amount of M2. And interest rate targets help to quantify this. Right? It helps answer the question of how much M0 do we need to put into the economy to get a given amount of broad money. And you'll notice that sometimes that answer is a lot. Right? This is a graph of M0 and M2 during the Great Recession. You'll notice that M0 quintupled over this period of time, from about 800 billion to about 4 trillion. And on the right-hand side, you'll see that M2 hardly even budged. Right? A little bit of a wiggle there, but not a whole lot. So what's going on here? Well, especially during a recession, the demand for money sometimes isn't stable. And that's going to cause the money multiplier to be unstable as well. Right? You'll see that prior to 2008, chugging along, 1 or 2 percentage points a year, maybe change. Right? And again, this is our general quantity theory case where the demand for money isn't really changing all that much. And then after 2008, you'll see that it's a little rockier, but not too out of line, right? We can still think of that as relatively flat. But look what happens in 2008. Kind of falls off a cliff there. Right? And this happened because people are demanding different types of money. This is our scramble to safety that's going to cut that money multiplier when the demand for money rises. And interest rate targeting is a way of trying to deal with this problem, especially when you can't count on that ratio being constant. So let me back up here and go into a little bit more detail on the mechanics of how this works. Right, when the Fed sets an interest rate target, what exactly is it doing? And specifically the interest rate on what? Because there are lots of interest rates in the economy, and the Fed's not going to have direct control over all of them. It's not even going to have direct influence over all of them. Right, so what exactly is it doing, and what kind of control does it have over them? So stepping back here, think about your account at your bank. You have some amount of money at the bank, and you hold that in terms of the bank's promises to pay to you. Banks have a similar sort of arrangement at the central bank, at the Federal Reserve. Right? So just like you or I have an account at our bank, banks have an account at the Fed. And sometimes it's called the banker's bank for that reason. And the reason for this is that it allows banks to settle debts among each other efficiently. Right? Or in other words, the Fed acts as a clearinghouse. Now, what do I mean by a clearinghouse? Imagine that I write you a check. Or let's say that I write the electric company a check. But the electric company doesn't have the same bank as I do. Right? So if I give a check to the electric company, and the electric company deposits it at their bank, how does this get settled? Well, my bank is now going to owe their bank money. Right? So the way that that money gets transferred is behind the scenes, my bank has to settle a debt with the electric company's bank. So at the end of the day, all those promises that have been spent and transferred from person to person, right, the banks have to go and settle those at the end of the day. So maybe some amount of checks got written from Bank A to Bank B, and some amount of checks got written from Bank B to Bank A. And they've got to net those, and they owe each other money at the end of the day. That's clearing. Right? Clearing is that netting of debts among all the different banks at the end of the day. Right? Because a lot of what you and I pay to each other, really in the background, is banks paying things to each other on our behalf. Now the problem with clearing is that if there's lots of banks, this can get kind of unwieldy. Right? You'll notice that the 5 banks here have lots of arrows between them. Right? Bank A's got to settle with Bank B and Bank C and Bank D and as many banks as there are. And that's a lot of transactions to manage at the end of the day. Right? If I write a check to somebody in California, there's going to have to be some kind of clearing transaction between my bank and this Californian bank. Right? And especially if you're in a global network, right? That's a lot of banks that every single bank has to deal with. So this is where the idea of a clearinghouse comes in. Right? The clearinghouse is going to reduce the number of transactions that any particular bank has to make at the end of the day. So the clearinghouse is going to net all the bank's transactions against one another. Now let me give you a concrete example. Suppose Bank 1 at the end of the day owes Bank 2 $5 million. But then there's a third bank that owes our first bank $10 million. But also Bank 1 owes a fourth bank $7 million. Right? If all these banks have to deal with each other individually, that's going to be a lot of transactions at the end of the day. But where the clearinghouse comes in is the clearinghouse says, all right, all of you just send your debts to me and I'll pay out what anybody's owed, and it all adds up to the same thing in the end, but it makes it a lot easier. Right? You have to do one transaction at the end of the day rather than as many transactions as there are other banks. Right? So instead of settling 3 different transactions here, Bank 1 can just pay the clearinghouse $2 million. And everything else in the background gets handled and netted out. So all the clearinghouse has to do at the end of the day is just a little math and divvy up that money to whomever it's owed. Now the central bank doesn't necessarily have to be the clearinghouse. As a matter of fact, the US didn't have a central bank for a long period of its history. But there were still clearinghouses. Right? Banks, in fact, early in US history would form their own clearinghouses cooperatively, because all these banks had an interest in making it easy to settle debts with each other at the end of the day. Now, clearinghouses, interestingly enough, also took on regulatory functions without any power to force anybody to do anything, right? This was cooperatively instituted by these banks, but clearinghouses were still able to serve as effective regulators. Why? Well, imagine that you're part of a clearinghouse and a new bank is established and they want to join the clearinghouse and settle debts with you. You're going to have an interest in making sure that that bank is being run competently and that its balance sheet is up to snuff. Because if it's not, that's going to burn all of the rest of you. And you're going to have an interest in making sure that any bank you deal with, any bank that's a member of the clearinghouse, is going to have a balance sheet that looks pretty healthy. Right? So it's not the case that banks would just give themselves a pass. Right? Because the incentives are such that every bank wants every other bank to be healthy enough to pay its debts. Right? They're all interdependent in this way, and so they police each other, or they can police each other. But in 1913, the Federal Reserve is established, and it takes over both the clearinghouse function and the regulatory function. Right, so this kind of got nationalized in 1913, but we did have something serving those functions prior to that as well. So let's go back to the question about how monetary policy works. Right, so the clearinghouse function of the Federal Reserve is pretty important to how it's going to manage monetary policy. Right, so let's go back to how banks actually operate, right, and what kinds of promises they make. Right, banks are going to have cash in order to fulfill the promises they make to you. Right? You can go to the bank and withdraw your money and redeem those promises that they've made and get your money back in the form of cash. And banks are going to have some amount of cash, some amount of that M0, in order to fulfill their promises to you. But most of the promises that banks make are not actually promises to you. Right? People coming into the bank and withdrawing their money is actually a pretty small portion of what banks have to do from day to day. The vast majority is going to be promises to other banks. Right? When you swipe your debit card, you're not withdrawing money, and the bank's not fulfilling its promise to you, but you're transferring that promise to somebody else, maybe at a different bank or with a different account at the same bank. And so in order to transfer that promise, banks are going to have reserves. Right? Reserves are also part of M0, and reserves are functionally equivalent to cash, except reserves are held at the Federal Reserve. Right? That's that bank's bank account at the Fed. And that's what banks are going to use to settle their promises with each other. Right? So these are generally deposited at the clearinghouse. Right? Prior to the Fed, banks would have an account at the clearinghouse in just the same way that they do today with the Fed. And they would settle their debts with each other that way. And so the Fed's going to have direct control over the quantity of bank reserves. Now think of yourself in the position of a banker. Right? Remember that banks' functions are to take money from consumers and intermediate that into loans to entrepreneurs, and then pass on some of the returns back to consumers in the form of interest. Right? So they're changing the maturity of the promise. They're receiving a promise and also making a promise. But the promise they make, both to you and to other banks, requires them to have some amount of reserves. Now here's the problem. Any reserves that the banks have is money that they could be lending out, but aren't. Right? So reserves are kind of dead cash. Right? So if you're a banker, you want to have enough reserves to fulfill your promises, right? Because it's bad news if you don't. It's bad news if you're not able to fulfill your promises. But you also don't want to have too many reserves. Because if you have too many reserves, that you're just leaving money on the table. You could be making interest on that, but you're not. So banks are kind of walking this tight line. And they don't necessarily know how many promises they're going to have to fulfill from day to day. Right? They have kind of a general idea, and they have enough to keep them safe. But, it could be more than they expect or less than they expect. So imagine you're doing pretty well, walking this line. Right? You've got neither too many nor too few, and you're doing fine fulfilling your promises. But now suppose that one day more people than usual swipe their debit cards or withdraw money. And all of a sudden your outflow is, not in dangerous territory, but making you a little uncomfortable. Right? You're getting a little low on your reserves. What you can do is you can borrow reserves. Right? If you have a temporary outflow and need to shore that back up to feel safe, you can borrow those on a short-term basis. And tomorrow they'll probably average out, and on average, you can count on a certain amount of outflow. Right? So if there's one day an unexpectedly high outflow, you can borrow those reserves temporarily just to shore yourself up, and then pay those back later on a slow day. On the other hand, suppose it is a slow day, and you've been walking the line pretty well so far, and then all of a sudden you've got all these reserves that you were planning on using to fulfill promises, but for some reason people didn't spend as much today, and so you're just sitting on these. Well, here's all this dead cash that you don't want to be sitting on, right? You want to be making money on this, but you also don't want to commit long term to locking that up, because tomorrow you might have high demand again. So you can also lend out excess reserves. Right? So banks that have too many reserves can lend out reserves to banks that temporarily don't have enough. And so you're putting that money out there, you're making a little bit on it, right? It's not completely dead, but you're also not putting yourself at a huge amount of risk in case things pick back up tomorrow. The market where banks do this, where banks borrow and lend bank reserves, this is called the federal funds market. Why is it called the federal funds market? Because bank reserves, remember, are issued by the Federal Reserve. That's that M0, right? So they're called federal funds, right? Or at least they were at one point. Right? So the federal funds market is the market where banks borrow and lend each other bank reserves, M0, on a very short-term basis, really usually overnight. And here's where we get back to monetary policy. When banks lend each other reserves, they're going to charge a certain interest rate. This interest rate is called the federal funds rate. And whenever the Fed talks about interest rates, or an interest rate target, it's talking about the federal funds rate. Right? So how does the Fed do that? How does the Fed influence the federal funds rate? Well, the Federal Reserve, remember, has direct control over the quantity of bank reserves. And by adjusting the quantity of bank reserves, it can hit a federal funds rate target. It can adjust the price of borrowing and lending reserves by adjusting the scarcity of those reserves. Right? So whenever you hear somebody say the Fed raised rates or cut rates, right? No, it never raises or cuts rates. Right? It's never forcing anybody to charge a certain price for anything. What it's doing is it's changing its federal funds rates target by modifying the quantity of reserves. And how do they modify quantities of reserves? Well, they're going to do that with open market operations. Right? They're going to absorb reserves by selling bonds, or they're going to increase banks' reserves by buying bonds. In other words, the open market operations are how central banks target interest rates. Let me show you this in a diagram here. This is the supply and demand of bank reserves. Right? The demand for reserves slopes down because the higher the interest rate, the less you're going to want to borrow. And the supply of reserves slopes up because the higher the interest rate, the more willing you're going to be to lend out those reserves. Now, suppose the Fed wants to increase the federal funds rate target. So what the Fed's going to do is it's going to use open market operations, in this case, to decrease the supply of reserves. And so the supply of reserves is going to fall. And when reserves become more scarce this way, the price of borrowing them is going to increase. Right? Just like anything else, if it becomes scarcer, the price is going to increase. And if you have fewer reserves as a bank right now, you're going to want a higher interest rate in order to be willing to lend the same amount. So this is how the Federal Reserve targets the federal funds rate, by increasing and decreasing the quantity of reserves using open market operations. Now I also want to emphasize that targeting an interest rate is very different from controlling an interest rate. Right? The Fed doesn't set prices. Right? So this is the diagram we saw on the last slide. When the Fed wants to set a target, what it does is it moves the supply curve. Right? So the federal funds rate is an equilibrium rate. The Fed just has control over the supply curve. On the other hand, this is what it would look like if the Fed were controlling rates. Right? If the Fed were to say, well, this is the rate you have to borrow and lend at, regardless of the equilibrium, right? That's a price control. That's going to lead to a surplus or a shortage. And the Fed doesn't do that. Right? The Fed doesn't want there to be a surplus or a shortage of reserves. And because it has control over the supply curve, it can cut the supply to raise rates or increase the supply to lower rates. Right? So it's not a price control. Right? We still have an equilibrium rate. We're not going to be in disequilibrium here. And similarly, when countries target exchange rates that we're going to talk about in the final lecture, right? It's going to be the same sort of process. They're targeting but not controlling because they have control over the supply curve. So when we say that Fed policy is contractionary, right, sometimes you'll hear this expressed as the Fed raised interest rates. You're going to want to translate that in your head to a contraction, or at least a slower expansion. Right? The Fed's going to be using open market operations to contract M0. It's going to be selling bonds and absorbing that money back and destroying that, right? Contracting the supply of bank reserves. On the other hand, when Fed policy is expansionary, sometimes you'll hear this expressed as the Fed is cutting interest rates, right? Or lowering its interest rate target, more precisely. You should translate this in your head to the Fed is using open market operations to expand the supply of bank reserves, to expand the supply of M0. Now, when the Fed does open market operations, this is going to have several different effects on interest rates. When it expands the supply of bank reserves, the direct effect is going to be that it lowers the federal funds rate, and it's going to make banks more liquid. This is something called the liquidity effect. Right? When banks become more liquid, they're able to afford to make more loans at lower rates. And so the liquidity effect is going to be the effect on the federal funds rate, as well as the effect on bank rates, the rates that banks are willing to charge other people who borrow from them. Now, there's also going to be a secondary effect. Because the Fed is doing a two-sided transaction, right? Not only is it increasing the supply of bank reserves, it's also buying treasury bonds, or vice versa. Right? So when it buys treasury bonds, it's increasing the demand for those bonds, it's increasing the price of those bonds, and that's going to decrease the return on treasury bonds. So it's going to lower the interest rate on government bonds. Right? And as we saw earlier, this is going to make it cheaper for the government to borrow. Now, imagine yourself as an investor, and part of your portfolio is treasury bonds. You hold some amount of government debt. Now, if the return on that government debt were to fall, how would you react as an investor? Well, you'd probably want to sell the assets with lower returns. You'd want to get rid of the government debt and buy something else with higher returns. Right? Maybe not your whole portfolio, but on the margin, you're going to get rid of some government debt and buy some of something else with higher returns. Now, what happens when you buy things with higher returns? Well, you're going to increase the demand for those things, you're going to increase the price on those things, and the rate of return on those things is going to fall. Right? So you're going to arbitrage any difference in rates of return. And just like we have a law of one price, again, we have a law of one rate of return, at least risk adjusted. We're going to call this the portfolio balance effect. When people arbitrage differences in interest rates and rates of return, this is going to spread interest rate changes out from the federal funds market, out from the treasury bond market, into other kinds of assets as well. So the way this works is that when the Fed expands the M0 money supply, and when the federal funds rate falls, and when the treasury rate falls, or you could imagine this happening in reverse too, when it rises. Either way, this is going to create a price differential. And when there's a difference in either prices or rates of return, people are going to arbitrage that away. And that's going to make the price differential go away, at least compensating for risk. So you can think of it like pouring honey. Right? If you've ever poured honey into a bowl, it kind of piles up in the center, which is to say that when the Fed expands the money supply, it's going to affect one market first. But then arbitrage is kind of like gravity. Right? It doesn't necessarily happen immediately, but that honey you're pouring spreads out over the whole surface. Right? And then the initial fall in interest rates in the first market, that's going to die away, but it's going to equalize with all the others as they rise through this portfolio balance effect. Right, so open market operations we can think of as having two stimulative effects. And again, stimulative effects are only going to be there in the short run. Right? These are going to die down once prices adjust. But in the short run, an expansionary open market operation is going to have an effect, first of all, on the volume of spending. Right? That's going to be the direct effect. So when the money supply rises, the volume of spending rises, and that's going to increase all the components of GDP. That's going to increase your consumption, your investment, possibly your government spending, and your net exports. Right? So that's your direct effect, your direct stimulative effect of open market operations, at least expansionary ones. Same is true in reverse for contractionary ones. Right? It's going to hit the volume of spending, which is going to hit all the components of GDP. Now there's also an indirect effect. Right? The indirect effect of open market operations, at least expansionary ones, is that it's going to become cheaper to borrow money because interest rates fall. And a fall in interest rates is going to make it cheaper to invest. Right? So investment, that I portion of GDP, that's going to increase in particular when interest rates fall. Now, remember, this is going to be a secondary effect. Right? The interest rates are not the stimulative thing in themselves, but they reflect the stimulative effect on the volume of spending. And there's also going to be kind of a smaller effect through investment in particular. And again, both of these are only going to be true in the short run. Right? Any kind of stimulus you get is going to die away. Or if you recover from a recession back into equilibrium, right, you're just accelerating that short run. Right? Or if you're not in a recession and you try to engineer a boom this way, it's not going to last very long. This is what Nixon tried. They weren't in a recession at the beginning of the 70s, and they tried to do this, and that led to stagflation, stagnation and inflation, if you remember. Right, so ideally, this is going to be a way of getting out of a recession. Right, this is going to be a way of raising the volume of spending in order to compensate for a previous fall. So let's run through how exactly that would work. So suppose that there's a fall in the volume of spending. Suppose in particular that people lose trust in the banking system, or one bank in particular maybe. And if you remember from last time, what has to happen when people lose trust in a bank? Well, people aren't willing to hold its promises as much, and so the bank's not going to be able to issue as many promises. And so best case scenario, it has to contract M2. Right? It has to reduce the number of promises it makes. Worst case scenario, the bank fails, and then all of its promises stop being money. So people are increasing their demand for M0. So the demand for money is going to rise, the money multiplier is going to fall, and the volume of spending is going to fall this way too. Right? This is our scramble to safety story. So we've got a scramble to safety that has the potential to send the economy into a recession. Right? The volume of spending is going to fall, prices are going to need to fall. But what if the central bank could satisfy that increased demand for money? Right? So people wouldn't need to run on the bank. Right? And then the bank wouldn't necessarily have to contract M2. And then we could avoid that fall in M2 entirely. So if the central bank is able to increase the supply of money, while the demand for it is increasing as well, right? If velocity is falling, then the money supply is going to be rising, and those are going to offset each other, ideally. If it can do that, and if it can do that in proportion to the fall in velocity, then the volume of spending doesn't have to change, and you've averted a recession. Here's what this looks like. If the demand for money rises, velocity is going to fall. Remember the logic behind that, right? People are wanting to hold on to their money rather than to spend it, and so the rate at which a dollar flows through the economy on average is going to fall. Right? So now suppose that the central bank increases the supply of money. So M rises. And if these offset each other, the volume of spending doesn't change, prices don't have to change, and it doesn't matter if prices are sticky or not. So hopefully this averts a recession. On the other hand, if the demand for money falls, velocity rises, the central bank can similarly cut the supply of money and avert a kind of a boom. So now we might want to know, well, okay, given that this is theoretically possible, is this actually what happens? How successful are central banks at doing this? And the answer is very mixed. Right? Central banks have a very mixed track record in doing this adequately. So there's a few issues we might want to raise with the ability to do this. First of all, what if the central bank doesn't have enough information? What if it acts too late, or isn't fast enough, or doesn't have the right knowledge in order to know either what to do, when to do it, or how much to do? Or maybe the central bank has other goals entirely. Right? Maybe its interests aren't aligned for whatever reason with the interests of the economy as a whole. Right? Any one of these three things is going to be sufficient to take us away from that ideal monetary policy. So here's Friedman again. Friedman had this idea called the long and variable lag, sometimes abbreviated LAVL, L-A-V-L. So suppose the central bank is looking to and fro throughout the economy, looking for changes in money demand to offset, and then it sees over there, yes, there's a rise in money demand. We better act quickly. But here's the problem. The central bank is out there gathering statistics, but by the time that rise in demand shows up in the statistics, the volume of spending has already fallen. Right? It's already too late. And so the central bank might say, well, better late than never. Let's expand the money supply. Let's increase the volume of spending. But by the time that kicks in, it might be the case that the economy is already recovering. Maybe the deflation has already happened, and so prices have already fallen. And if that's the case, then by trying to stabilize the volume of spending, the central bank can inadvertently end up destabilizing it. So let me illustrate this for you. There's a story in 4 parts here. In part 1, there's an aggregate demand shock. Right? People, let's say, increase their demand for money. Velocity falls, the volume of spending falls, and in the short run, prices are sticky, and so real output is going to fall as well. Right? You get that little dip up there. Now the central bank's going to expand the money supply at the trough here. But now the economy is starting to recover. Right? Prices are adjusting downward, and real output is starting to return back to where it was. And at that point, that's when the central bank's monetary expansion kicks in. Right? Because it doesn't happen immediately. And if the economy is already mostly or partially recovered by the time the central bank's expansion kicks in, right, prices are going to have to fall, and then prices are going to have to rise. And so you get, instead of flattening out that recession, you just get a boom right after your recession. Right? That's not necessarily what you want, right? But that's a potential problem if the central bank can't act quickly enough, or if the expansion takes a while to work its way through the economy. The second problem is one of incentives. Right? It might be the case that the central bank has other goals in mind. Maybe the goals of the central bank aren't aligned with the goals of people in general, or the economy as a whole. Right? Now, central bank independence is a way of reducing this problem. Right? If the central bank is not independent of the executive branch, then there's a clear conflict of interest between the central bank's incentives and the economy's needs. Right? And the central bank will tend to inflate more than is desirable for an economy. Right? We've seen this in the last lecture as well. Now, it also might be true that there are other factors that give the central bank an incentive to do something other than what's good for the economy. And again, this isn't an issue of them being particularly bad people or incompetent people or anything like that. This is an issue of the incentives they face and people doing the best they can in light of the situation they're in. Right? Again, don't hate the player, hate the game. So think of yourself in that situation. Think of yourself as the chairman of the Fed. What kinds of things might you be interested in other than ideal monetary policy? Well, maybe the same things that any of us are interested in. Right? Maybe something like job security. Right? All of us are interested in having a stable job. And people who work at the Fed are no different. And you can't really blame them for that either. Another thing they might be interested in is expanded ability to do the things that they want to do. Right? If you're a manager, it might be your goal to expand the number of people under you, to get more authority in your company, to be able to manage more projects, and to move up in rank. People at the Fed might have the same incentives. And again, you can hardly blame them, right? These are recognizable incentives that you and I face as well in our jobs too. Here's an example from the 1990s, when Alan Greenspan was in charge of the Fed. Suppose you're in charge of the Fed, and for whatever reason, Congress keeps hauling you in to testify. And you know these representatives, they're maybe smart people, but they don't know anything about economics, especially about monetary policy, and you want to preserve the Fed's independence. Right? And so in principle, you could say, buzz off, you have the legal authority to do that, but you also don't want to burn any bridges. So Greenspan's strategy was something called Fed speak. They'd call him in to testify, and he'd give them this big, long, complicated answer that sounds like, that sounds pretty difficult. Sounds like he knows what he's doing. May as well leave him alone. And you can imagine this being a noble thing or a less noble thing. But either way, it's a way for the Fed to be able to do what it wants. Right? That might be better than what Congress wants it to do, probably is, or it might be something different entirely. Right? But those are some of the incentives that they face. Here's another example. When we're thinking about open market operations, you might think that, if the Fed wants to expand the money supply by $100, then it's going to buy a $100 bond. Right? Pretty straightforward. As a matter of fact, in practice, not really how it goes. Right? So on average, every $1 of monetary expansion that the Fed does is the net result of $184 worth of purchases and $183 worth of sales. So if the Fed expands the money supply by $100, it's going to expand it by $18,400 and then contract it by $18,300 on average. Similarly, during the Great Recession, when Ben Bernanke was the chairman of the Fed, initially at least, and we'll see this later when we see the Fed's balance sheet, initially during the crisis, the Fed wasn't expanding the supply of money at all. All it was doing is shuffling, right? Moving things around on the balance sheet and swapping treasury bonds for other things. Now, why would they do this? Why would they expand a bunch and then contract a bunch for a small net effect? Why would they do all this shuffling before expanding the money supply? Why make things so complicated? Well, they haven't given us an explicit reason, and so this is to some extent a matter of speculation, but you can imagine it makes sense in terms of the incentives they face. Right? So for example, it might seem like the Fed is working harder this way. And again, you can imagine this incentive playing out in your own job. Right? If you're having a down day, or if you have a lot of down days at your job, and you're worried, hey, maybe this job isn't really necessary anymore. And if I'm honest with my boss about that, maybe I'm going to get fired. And maybe they don't need me. So what do? Well, you look busy. And the busier you look, the harder it is to fire you. And you can say, well, gosh, I've been working so hard all day. Was it something that needed to be done? Not necessarily, but nobody needs to know that. Right? And that makes it difficult to fire the people who are doing the churning. Right? The Fed's a huge employer of economists, kind of a jobs program for economists. And just like anybody else, right, they don't want to get fired. So the more people you have doing busy work, the easier it is to justify a larger budget, the harder it is to fire people. And so every time you hear a debate about cutting government spending, for example, one of the recent examples is the post office, right? People are trying to streamline the post office, maybe cut some of the funding, eliminate some of the inefficiencies. And every time, you're going to hear all the stories about all the federal workers who might lose their jobs. And having talked about labor and unemployment, we know that those jobs have opportunity costs, right? That's labor that could be employed doing something else. But there's huge pressures to keep people employed in a bureaucracy. Right? The incentives are such that you want to hire as many people as possible and keep them employed. Right? So no matter how unproductive those jobs actually are, that's one of the big incentives facing bureaucratic management, as opposed to management on a market. Right? There's a lot less incentive to get rid of unproductive labor and to reallocate that toward more productive uses. And again, not because anybody here is a bad person necessarily, not because anybody is particularly lazy. These are the incentives that are operating in these situations. And you can imagine yourself acting in exactly the same way in those circumstances. So if these problems are things we want to fix, right, it doesn't do any good to just say, well, these are bad people and we need to, get rid of the bad people, put in good people, right? That's kind of beside the point. What we need to do is change the incentives. That's how things like this get changed in a durable way. And that's really hard to do. Right? That's a very difficult problem to solve for the same kind of reasons that make economic growth a difficult problem to solve, as we talked about in homework 3. Here's another example. The story I told about why the Fed targets interest rates. Semi-convincing story, right, under certain conditions. But Friedman suggested that interest rate targeting actually makes it harder to figure out how much to expand the money supply by or contract. So he says, why the enormous resistance to just directly targeting monetary aggregates? Why not just target M2 rather than interest rates? Or maybe even a broader aggregate would be even better. Because it's easier to monitor. Right? It's easier to tell the connection between a broad monetary aggregate and the volume of spending than it is for interest rates and the volume of spending, which is kind of opaque, and you have to tell a story that's a little circuitous. Right? And again, not because anybody's being particularly bad here, but because, like anybody, you want the freedom to do what you have to do without anybody writing you about it. And if you imagine your boss coming in and breathing down your neck about a project that let's say you know how to do it, your boss doesn't, and he's breathing down your neck, and you're like, what the heck? Get off my back. Right? Friedman's saying that's what the Fed's doing here. Right? And this is a way of telling your boss, get off my back, and saying, hey, no, don't worry about it. This is really complicated. I got this. So Friedman actually proposed that you could replace the Federal Reserve with a computer. Right? Now, you can imagine that may have certain benefits, certain drawbacks, but in principle, you could do that. But just like you or me, just like the Luddites, just like anybody else, nobody wants to be technologically unemployed, right? Not even people at the Fed. So there's going to be resistance to this. There's always resistance to the threat of technological unemployment. And there's ways of getting around that, but you have to expect that. Right? You can't really blame anybody for being upset about that. So all these things together, we might want to know, well, okay, overall, maybe these are big problems, maybe they're small problems. Maybe all these problems exist, but they're small enough that the Fed still does a good job on average. Or maybe they're so big that the Fed doesn't do a good job. How would we evaluate that? Well, one way of evaluating that is by looking at the stability of prices. And the stability of prices is going to give us kind of a rough way of figuring out whether the volume of spending is stable or not. Right? If the volume of spending is unstable, prices are going to need to rise and then fall and then rise and then fall. Whereas if the volume of spending is relatively stable, prices are going to be relatively stable as well. And what this shows us is that prices were more stable prior to the Fed. Right? This diagram shows us on the left price forecasts on average on a 5, 30, and 100-year horizon prior to the Fed. And then on the right-hand side, it shows us price forecasts on average on a 5, 30, and 100-year horizon after the Fed. Now, this is remarkable for several reasons. First of all, you'll notice that the price forecasts are a lot flatter prior to the Fed than after. Now, a big part of the justification for the Fed was the fact that the US had a really dysfunctional banking system. And you had all kinds of panics and crashes just because banks were so fragile. Remember, I mentioned a few lectures ago that branch banking was illegal, meaning that all the banks in the US were really small and fragile and really prone to bad panics and crashes and recessions and things like that. And the Fed was supposed to put an end to that. Right? And amazingly, prices on average and the volume of spending on average was more stable even with that dysfunctional banking system prior to the Fed than after. We're not even counting the Great Depression here. Right? You'll notice that this is prior to 1913 and after World War II. So that whole Great Depression period, right, we're counting that as kind of a mulligan. Right? We're saying, okay, we'll give you a pass on that one. That one doesn't count. Even so, price forecasts are still less stable post-World War II than they were pre-Fed. Here's some more direct evidence. This is a graph of the average response of the money supply to a shock in money demand. So if money demand rises, you want money supply to rise as well in order to avoid a shock to the volume of spending. And what this shows us is that prior to the Fed, the money supply was actually more responsive to money demand than it was afterward. Right? You'll see both of them are responsive, but a bit of a shallower curve, a bit of a slower response after World War II. Now that's a little weird, right? How is this possible? How is the money supply responding to money demand if you don't have a central bank? Well, the reason for this is that the adjustment was happening in M2, right? Not in M0. Right? The Fed kind of took over a lot of the functions that banks were providing, and banks were able to expand M2 when the demand for money rose in a way that's a little harder now. Not only because the Fed took over some of that role, but also because of regulatory barriers. Right? Banks aren't able to respond as quickly as they otherwise would have by expanding their balance sheets in response to an increase in the demand to hold money. So one other thing you might want to know is, why does the central bank generally use government debt in order to do open market operations? Couldn't it do open market operations with anything? Why does it choose government bonds? Well, there's a few different reasons. First of all, the revenue reason. Right? We've talked about seigniorage. Right? By buying government bonds, it lowers the return on government bonds and therefore makes it cheaper for the government to borrow. The government also doesn't pay interest on debt held by the Fed, and so you can imagine that as kind of free debt. Right? There's a big incentive for governments to take advantage of that. Now, that being said, central bank independence is supposed to short-circuit exactly this problem. Right? It's supposed to take away the incentive for governments to abuse this privilege. And what we see is that even independent central banks still do open market operations with government securities. So there must be some other reason if you took away the revenue incentive. And one important reason is that this is going to avoid biasing monetary policy toward any particular sector of the economy. Right? So the goal of monetary policy is to be as neutral as possible with respect to the economy as a whole. Why? Because imagine if the Fed had the power or the ability to do open market operations with any kind of asset. It would be very profitable if you were able to convince the Fed to buy your stocks or your bonds. Right? So if you're the head of Microsoft, you might be willing to spend lots and lots of resources lobbying the Fed, hey, if you could do open market operations with Microsoft stock, that would make it a lot cheaper for Microsoft to borrow. That would make it a lot easier for Microsoft to raise money. So there's an opportunity for corruption. There's an opportunity for political allocation. There's an opportunity for the Fed putting its thumb on the scales of who succeeds and who fails. Right? You don't want that decision being made by people at the Fed. You want that decision being made by consumers. Right? So in a world where whether Microsoft succeeds or fails is determined not by consumers, not by the value they create, but by whether they can convince the Fed to buy their debt. Right? That's not a world we really want to live in. Now, there are certain rare occasions where central banks will do monetary policy with something other than treasury bonds. This is something we'll call quantitative easing. Right? Quantitative easing is very often an emergency measure. Right? The US did this in 2008. Japan's been doing it since the 90s. Right? So in 2008, the Fed bought up over $1 trillion worth of mortgage-backed securities. And what this did was it prevented some banks from having to contract M2. Remember the bank failure story we told in the last lecture. When enough loans turn bad, banks might be forced to contract, and that's going to send the whole economy into a recession. These mortgage-backed securities were loans to homeowners, and specifically to homeowners who weren't likely to pay back their debts. And when a lot of them didn't pay back their debts, for the reasons we talked about before because of these Basel regulations, a lot of these banks started needing to contract their issues. This was going to threaten to send the economy into a much worse recession. And so the Fed, rather than buying treasury bonds, because a lot of these banks didn't have enough treasury bonds, right, where they were hurting was these mortgage-backed securities. So the Fed bought the mortgage-backed securities off of them. And that's quantitative easing. Right? And it was able to expand the money supply that way. And we can see this happening here. Right? Look at it, 2008, when treasuries are decreasing and other is increasing, but it's staying flat for that first little bit. Right? That's what I pointed out earlier when Bernanke was just kind of shuffling things around without really expanding the money supply. Then in the middle of 2008, you realize, hey, we're going to actually need to expand the volume of spending here. And so you see a huge rise in mortgage-backed securities. Right? The Fed is buying mortgage-backed securities and increasing the money supply by paying for those with new money. And you can see several rounds of this quantitative easing. Right? In 2008, we had quantitative easing 1, then quantitative easing 2 is that second bump, and then number 3 is that third bump. And then that's been slowly wound down over the past couple of years. And that'll probably be going on for a very long time. So to sum up, there's several different ways you can talk about monetary policy. You can either talk about changes in M0, or you can talk about it in terms of changes in interest rates. Right? Changes in M0 are going to be probably the more appropriate way of talking about monetary policy, even though interest rates are the more usual way. Right? Why is it more appropriate to talk about it in terms of M0? Because that's going to be how the central bank affects the volume of spending directly. Right? And this is what monetary policy is designed to do, to either increase or decrease the volume of spending. And any effect that interest rates have on investment is going to be pretty secondary. And ideally, monetary policy is going to want to offset any changes in the demand for money with changes in the money supply, which is to say that it wants to stabilize the volume of spending in order that prices don't have to rise or fall, right? In order that you don't get either recessions or booms. But for a variety of reasons, that's difficult. So now let's move on to our second tool. Our second tool is called fiscal policy. And the idea of fiscal policy is that if the volume of spending is low and prices have yet to fall, government spending can pick up the slack. Now, fiscal policy is composed of two parts. The first part is what are called automatic stabilizers. Automatic stabilizers are government programs with variable spending that depends on where we are in the business cycle. So for example, unemployment insurance would be an automatic stabilizer. When we're in a recession, more people are unemployed, and the government's going to spend more money on unemployment insurance. Right? And to some extent, that's going to offset. The second part of fiscal policy is going to be stimulus spending. Now, stimulus spending is going to be special measures. It's going to have to be passed by an act of Congress, and that's going to be government spending that's supposed to increase the volume of spending. Now, why would we imagine that fiscal policy could be a thing that works? Well, the theory goes this way. Suppose that nominal output is depressed because of a recession, and we want to raise nominal output. And so we start with our GDP buckets equation, our y equals c plus I plus g plus x. The idea goes that if we raise g, all else equal, we would like to raise y in addition. And ideally, this is going to get us out of a recession. So all else equal, remember this is an accounting identity. Both sides of this equation have to be equal. So if g goes up, something else is going to have to change to keep that equal. Hopefully that's going to be y, right? Hopefully you're going to increase output. Now the question we're going to ask is, does it make sense to say all else is equal? Can all else be equal? And will the effect be to raise y, or is the effect going to be something else? And to answer this question, we're going to combine the equation of exchange with our GDP buckets equation. All right, so we start with mv equals py, and remember that p times little y is going to be equal to big Y. That's just our real nominal GDP equation. All right, so mv equals capital Y. And we also know that capital Y equals c plus I plus g plus x. That's our GDP buckets. And so we can combine these equations and see that mv equals c plus I plus g plus x. And writing it out this way is going to give us a framework for evaluating the effects of both monetary and fiscal policy. So because we write it this way, we can see exactly where monetary policy comes in. That's going to be this m. So monetary policy is going to hit the left side on the m, whereas fiscal policy is going to hit the right side on the g. Right? That's our government spending. Now we know from talking about this earlier that the volume of spending depends on the money supply and velocity, right? Or in other words, money supply and money demand. So if the money supply doesn't change, and if money demand doesn't change, the volume of spending is not going to change either. So where does fiscal policy come in? If G rises, does that affect the money supply? Does that affect money demand? Or does that affect something else on the right-hand side of the equation? And the answer to that question is going to be, well, it depends. What does it depend on? It depends on how you fund it. Where does the money come from that you use to increase government spending? And in general, you can imagine 4 ways that government spending might be financed. Right? So there's 4 sources of income that governments are able to draw on in order to spend money. The first and most obvious is going to be taxes. Right? You collect money from people, and then that's money that you can then spend. The second way you can get money is borrowing, or what's sometimes called deficit spending. Right? In order to do this, you trade money now for a promise to pay later. You go into debt. You issue treasury bonds. And then that's money you have to pay back at some point in the future. The third way you can get money is if you've accumulated a surplus. Right? If you've had a budget surplus in the past and the Treasury's sitting on some money, the Treasury can go and spend that money that it's accumulated. So you can think of these first 3 as taxation being current taxation, borrowing would be future taxation because you have to pay the money back later, accumulated surplus would be past taxation because that's where you got the money from, and then the fourth way of getting money would be monetization that we've seen before, when the government forces the central bank to buy its debt and essentially finances government spending with issuing new money. And whether fiscal policy works or at least whether it's going to be effective at raising the volume of spending, is going to depend on which one of these is used to get the money that's spent. So let's take these one by one. And we'll start with taxes, since taxes is kind of the most obvious way that governments get money. So in all of these, we're going to start with government spending going up. So our G bucket is going to rise. And this is going to be paid for by increasing taxes. Now, where do taxes come from? Well, taxes come from you and me, right? So consumption is going to fall. All right, so you can see that financing fiscal policy this way probably is not stimulative, right? You don't want to raise taxes in a recession. All you're doing here is moving spending from one bucket to another. You're not increasing the volume of spending, and so this isn't going to be stimulative, even in the short run. And what you're probably going to do is increase political allocation at the expense of market allocation. Right? So this is going to have negative long-run effects in addition to no short-run effects. So how about borrowing? Well, again, we start with government spending going up, and now the government's going to borrow the money. It's going to issue promises and say, I'll pay you back later. So let's think about what kinds of effects this might have. Suppose you're an investor, and the government comes to you and says, hey, can you spot me some money, and I'll pay you back later. What do you say? Well, you say, well, what's in it for me? What's the rate of return? And the government says, well, I'll give you maybe like 1%. And you say, get lost. Right? If I'm getting 1%, I can get 2% on anything else. And so the government says, all right, I'll give you 3%. And you say, all right, now we're talking. So the government's got to outbid alternative investments in order to issue that debt at all, in order to get people to buy it. Right? If it doesn't, then nobody buys the debt. And so by directing your money away from other kinds of investments and toward government debt, what they're doing is decreasing the funds available for other kinds of investments. Right? The money that you would have been investing in a private company or an entrepreneur or some kind of capital project. Now that money is going to the government because they're able to outbid some of those alternative investments. So rates of return are going to rise, all else equal. Right? Governments are going to have to bid up the rate of return or bid down the price of bonds in order to compete in the open market. So all else equal, interest rates are going to rise, and it's going to become harder for alternative investments to get made. Right? The supply of funds available to those alternative investments is going to fall. So investment's going to fall. Right? And it's a little less direct of a story here, but the effect is essentially the same as the last one. Right? We haven't increased the volume of spending. Right? We haven't affected the money supply. We haven't affected money demand. What we've done is we've moved spending from one bucket to another. And similarly to the last one. Right? This is probably also going to entail increases in political allocation at the expense of market allocation. And so in addition to having no short-run effect, it's also going to have negative long-term effects. So you don't really want to do this in a recession. Right? You don't want to bid up interest rates in the middle of a recession. That tends to be bad for investment as well. Now, how about the third? If the government has a surplus that it's accumulated, and it starts spending out of that. Right? Again, we start with our government spending going up, but what else has to change in this case? Well, you can think of it this way. You had some money that was sitting at the Treasury, not being spent. Right? They had accumulated it, and it's just sitting in a pile. And now that pile's being spent. What you've done is you've increased the average number of times that a dollar changes hands in the economy. Because all this money that was changing hands 0 times, just sitting there at the Treasury, now it's circulating. Now it's changing hands. And so velocity's going to go up. Right? And you can imagine that the government lowered its demand for money. Right? So it was holding money, now it's spending it. So because the government's such a big spender, that can make velocity on average go up. Now this one, unlike the previous two, this one affects the left-hand side of the equation. And so this is actually going to be stimulative. It's not going to take away those negative long-run effects, of increased political allocation necessarily, but you at least get the short-run effect of stimulus. Now, I also want to note one other problem with government spending financed by an accumulated surplus. It's that, well, you got to have one, right? If you don't have an accumulated surplus, this option is just kind of off the table. If you've been running big deficits and there's no money sitting at the Treasury just to be spent, you're going to have to resort to borrowing, taxation, or monetization. So realistically, political incentives are such that governments are very rarely going to accumulate a surplus. In fact, there's only a few in the world who do. Germany, China, maybe a handful of others. Everybody else, nobody's going to have that accumulated surplus. Right? So even if in principle this would be stimulative, it requires a lot of foresight. It requires you to store up revenues in good years in order to be able to spend it in bad years. This is kind of the ideal Keynesian fiscal policy that's supposed to store up money in the good times, spend it in the bad times, and so offset business cycles that way. In practice, it never really works out that way, right? Governments are very loath to spend less than they take in, right? For a variety of reasons that we'll talk about shortly when we talk a little bit more about political incentives again. How about this last one, monetization? Again, we start with government spending going up, but now the government wants to monetize that increase in spending. So what it does is it borrows the money, it issues the bonds, but rather than selling them on the open market, it has the central bank buy them. And so what you're essentially doing is you're expanding the money supply in order to finance government spending. So the money supply is going to go up. And like the last one, but unlike the first two, this is going to affect the left-hand side of the equation. And so this is actually going to be stimulative. This is going to have a short-run effect on the volume of spending. But notice that it's M doing the work and not G. Right? If M goes up and anything on the right-hand side goes up. And so you'll notice here that fiscal policy can never be more effective than monetary policy. Right? Because as effective as it can possibly be is just as effective as monetary policy. And monetary policy also, ideally, doesn't have the effect of increasing political allocation because you're increasing that money supply through banks that gets distributed generally and not to particular politically allocated beneficiaries, as would be the case in fiscal policy. Now, a lot of you have probably taken a civics class in high school. And one very common notion that people come away with from high school civics class is that World War II got the US out of the Great Depression. Right? This is a line you'll sometimes hear repeated in various quarters. And the idea is that fiscal policy helped out. Right? That the Fed was doing whatever it was doing, just kind of puttering around and trying to help, but nothing was really working. And then finally, the US went to war, government spending helped, and then the US got out of the Great Depression. Now, there's a sense in which this is kind of sort of getting at something true, but there's also a sense in which this is really highly misleading. Now, remember when we pointed out in the last lecture that war is very often associated with inflation. Why? Because governments need emergency revenue, and monetization is the fastest way of getting emergency revenue. And so the volume of spending is going to rise in that case. Right? Prices are going to rise, and the volume of spending is going to go up. So that's the sense in which it's kind of sort of true. Right? The volume of spending was too low, and prices were needing to fall, and because of a variety of things that Hoover and FDR both did, prices were not able to fall. And so we get this prolonged depression. And the Fed is new, right? Didn't really know what it was doing at the time, and so was not doing monetary policy effectively. Right? It thought it was expanding, but because it was looking at interest rates and not the money supply, right, it turns out that the money supply had contracted a lot, even though interest rates were really low. And so, by financing government spending with monetization, what this did was it kicked the Fed in the butt and forced it to increase the money supply in a way that, for whatever reason, it wasn't doing before. Could the Fed have done this before? Absolutely. And Ben Bernanke has even said as much. He said at a speech on the anniversary of the Great Depression at one point, he said basically, our bad, right? We won't do it again. Now we know what we did wrong. And that's why in the previous graphs, when we're comparing the Fed to prior to the Fed, we kind of give the Great Depression as a mulligan, right? Because they didn't really know what they were doing at the time. And, we can imagine them not making the same mistake again. Right? So if they'd have done monetary policy initially, it's very possible that the Great Depression didn't need to be as bad as it actually was. And so the government spending wasn't doing anything on its own. All it was an inducement to the Fed to do what it ought to have been doing all along, and something that the Fed very much knows to do from the get-go now. Now, the sense in which this is very much not true, that World War II got the US out of the Great Depression, is that war, remember, is a negative-sum game. Right? So going to war is a huge increase in political allocation. Right? The US is requisitioning all kinds of resources that could have been satisfying your wants and my wants, but now are going to tanks and airplanes and things like that. You might say, okay, well, it was an emergency. Right? Maybe that was necessary for the US to survive, and maybe that's true. Right? But in any case, the cost in terms of long-run economic efficiency and the ability of the economy to efficiently satisfy wants took a big hit. And again, you might say that cost is worth it, but it was a cost. So war is always going to be negative sum in this way, right? War is never good for the economy in any kind of long-run sense. Right? Whether or not it's worth the costs, it's always costly. So inflationary finance did help the volume of spending catch back up to the price level that had been prevented from falling previously. But the war wasn't necessary to do that. Right? It wasn't the war and it wasn't the government spending that did that. It was the monetary policy that the Fed ought to have been doing prior to that. All you needed the whole time was expansionary monetary policy. So let me give you an example of how not to do fiscal policy. This is a projection of the unemployment rate in 2008, put together by a couple White House economists. And they said that, well, this recession is looking pretty bad. If we don't do a stimulus, unemployment's going to rise to 9%, and then it's going to take until 2014 about to recover. But if we do fiscal policy, unemployment's only going to peak at less than 8%. And then we're going to recover probably in 2012 or 13. Right, so this sounds like a pretty good deal, right? But how is this financed? Right, the 2009 fiscal stimulus was financed by borrowing. And so it wasn't really particularly stimulative. And so the actual unemployment rate, somebody took this and superimposed the actual unemployment rate over this projection, turned out to be even higher. Right? Because not only did you not get a stimulus, you also got long-run effects of increases in political allocation. Right? You have resources going not to their most valued uses, but to whatever pet projects that the government wants to spend those on. Right? So these are questions you don't want to run through the electoral process or the political process, right? Because there's no method of getting at efficient want satisfaction that way. Right? And so the economy actually got less efficient, not only in the short run, but also in the long run during this period of time. Now, another thing we might want to know when comparing monetary and fiscal policy is which one's going to be more powerful. Right? So when monetary policy and fiscal policy are working in opposite directions, monetary policy is almost always going to win. Why? Because monetary policy is operating directly on the volume of spending, whereas fiscal policy, government spending, at best operates indirectly through the money supply or through money demand. So let me give an example from 2013. In 2013, if any of you remember, the government shutdown was the big thing in the news. Right? We're just coming out of this recession, and if the government shuts down, there's going to be a lot of government spending that doesn't get spent, and this is going to be essentially contractionary fiscal policy. Right? This is going to reduce the volume of spending. If G falls, then this is going to plunge us back into another recession. Now, 2013 came and went, the government shutdown happened, and what happened to the volume of spending? Essentially nothing, right? The volume of spending did not really get affected by the sequester at all. Why not? Because as this policy piece says, Fed officials were determined to expand the volume of spending enough during the sequester to keep the recovery going, despite the fact that the shutdown had decreased government spending. And they seem to have succeeded. Right? So this is actually a big success of monetary policy in 2013, is avoiding that double dip recession. Why are they able to do this? Because they can see changes in fiscal policy coming in a way that it's a lot harder to see changes in money demand coming. Right? So they were prepared, right? And they knew exactly how much to expand and what to do. And nobody really noticed any broader economic effects on the volume of spending from this shutdown. So the conclusion here, that the Fed's ability to produce almost unlimited amounts of fiat money, because its money isn't a promise to anything, monetary policy can, in principle, increase the volume of spending however much it needs to. And that makes monetary policy a lot more powerful than fiscal policy, right? Because you're not limited by budget deficits or by anything like that. Right, so this is an extremely powerful tool, and powerful enough that this is exactly why central banks have to be independent. Right? Because you don't want this tool in the hands of people who would be prone to misusing it. Not necessarily bad people, but people who would have an incentive to use it in ways that don't comport with the interests of the economy as a whole. So in this case, central banks very often offset fiscal policy. Why? Because very often the incentives are such that fiscal policy is not doing what it needs to offset changes in the volume of spending. Right? If the volume of spending is falling, in this case, right, we might get a fall in fiscal policy or contractionary fiscal policy. In good times, right, government officials have the incentive to expand as well. Right? We saw this during the most recent boom, when government budget deficits were running at record levels despite the fact that the economy was booming. Right? The Fed's going to want to offset that. It doesn't want that to accentuate that boom. And so in both directions, right, the Fed's really kind of keeping a brake on fiscal policy. So especially if the Fed is trying to neutralize what fiscal policy is doing. Right? Fiscal policy is really not going to be that effective in practice. Now, we talked a bit earlier about the incentive problems facing central banks when they do monetary policy. Maybe they don't have enough knowledge, maybe they're not able to act in time, or maybe they have incentives to do other things. But we know that central banks are more benign when they're independent of the political process, right? So there's not that temptation to put your hand in the cookie jar. Can't really have an independent treasury, right? That doesn't make a lot of sense, right? So the treasury can't be independent of the political process. So anything you run through the treasury is necessarily going to be politically allocated, and it's going to come with all of those dangers that are associated with that. So the incentive to get reelected implies very different things than the interests of the economy as a whole. That's exactly why you want the Fed to be independent of the political process. And that's exactly why fiscal policy can have such negative efficiency effects. And if you remember from the unit on growth, the more resources you have allocated by political allocation, the more control that the political process has over how resources are allocated, the less able that economy is to allocate resources to their most valued uses and to satisfy the most possible needs with those resources. Right, so fiscal policy runs into this problem a lot more severely than monetary policy does. Right, it has the same problems in terms of not knowing where to spend the money, not having an incentive to spend it, not being able to spend it quickly or slowly enough. Right, but in addition to that, there's also all the problems of political allocation. So let's bring this around to current events now. This is a take that has been floating around in various forms after the Fed announced a $1.5 trillion credit line to a lot of different banks. A lot of people got very mad at this because they looked at that $1.5 trillion and said, well, what else could that have been spent on? Right? They could have given us all $7,000 if that was spent on giving money directly to people. Or some people pointed out that this could have wiped out all student loan debt. But that comparison really misses the point. Right? In particular, this guy is confusing monetary and fiscal policy. Right? The Fed's extension of that $1.5 trillion was not a fiscal policy operation, and it wasn't a bailout. Right? Bailouts would be something that Congress does. Congress would appropriate money and bail out somebody like GM, or maybe even a bank, or something like that. In this case, nobody got bailed out. Nobody was handed money. Right? You can hand out money with fiscal policy. Monetary policy doesn't generally work that way. In this case, that $1.5 trillion was not spent. Right? It wasn't appropriated and given to anybody. What happened was that this was an asset swap, and in particular, a short-term loan. Right? The Fed was able to buy certain assets from other banks, similar to what they did with mortgage-backed securities, but even less important than that, because it was such a short-term loan that came with a promise to buy those back. Right? So it was a very temporary liquidity injection just to make sure that M2 was not falling unnecessarily. And that would have sent the economy into a much worse recession and compounded the problems of the virus and the shutdown. So the Fed's very keen on avoiding any unnecessary contractions in the money supply or the volume of spending. And that's what the goal was there. If you wanted to do something like send everybody a check, right, which the government later did, right, now we have the CARES Act, which is a record-breakingly large stimulus package. Right? That's going to be fiscal policy. That's going to be mailing people checks. And that's something different than monetary policy. Right? And that's going to come with different problems. So you don't want the Fed to have the ability to just give people money. Right? Whether that's banks, whether that's people, whether that's corporations, right? You don't want them to have that ability because that ability is going to get abused. Right? And even Congress, who's constrained somewhat by government budgets, right? They still give out a lot of those sorts of favors, bailouts, whether to people, to banks, to corporations. Right? This is the kind of thing that you don't want the political process in charge of because it gives incentives to use that money poorly and in ways that don't satisfy people's needs. So let me harp on this point just a little bit more. In a market, you're constrained to use your resources efficiently, right? Because if you don't, then you're going to make a loss and you're going to have fewer resources to reinvest, and eventually you're just not going to have anything left. Right? There are signals, specifically the signal of making a loss, that prevent you from wasting too many resources in an economy. On the other hand, you get rewarded with more resources by satisfying wants. Right? That's that profit signal. That profit signal doesn't exist in fiscal policy, in political spending. Right? Congress doesn't make a profit or a loss, right? Because Congress can tax, Congress can borrow. And so there's very little motivation to spend those resources in ways that satisfy more urgent wants before they satisfy less urgent wants. Right? All the incentives are to campaign for re-election and to maybe funnel money toward interest groups that'll help you with re-election. Right? That's very different than an economic problem where you're trying to maximize the needs that you satisfy with a given amount of resources. Right? So again, there's kind of a divergence in interests here. Right? The incentives are such that there is not an incentive to spend those resources efficiently. And even if they wanted to, even if you had somebody with a pure heart of gold who wanted to spend fiscal policy resources efficiently, right? Because they're not spending this money in competition on an open market. Right? Government procurement is not really a competitive market, and they're not even trying to make a profit. Right? So there's no ability for them to even know how to spend that money efficiently. So let's go back to the 2009 stimulus. $1.17 trillion gets spent on just stuff that is probably not that important in the grand scheme of things. And this is going to have an efficiency cost. Right? This money has an opportunity cost in a way that monetary policy really doesn't. Right? Because this is money that was appropriated from other purposes. So in this case, you see lots and lots of money appropriated for things like trains, funding for pet projects, National Endowment of the Arts, and you'll notice here this last sentence, much of which won't actually flow into the economy until long after economists expect the current crisis to subside. Right? So there's long and variable lags in fiscal policy too. And in this case, not only did you not get a real stimulus because it was financed by borrowing, right? It didn't really affect the volume of spending all that much, but you've also taken resources away from private investment in order to funnel them toward these sort of politically favored projects. And that's going to hurt the economy in the long run. Right? This is going to be a long run sort of misallocation where there's inefficiency. So let's sum up here and compare our two tools, monetary policy and fiscal policy. And we're going to want to know for each of those, do they have an incentive to use resources efficiently? Do they have the knowledge to do so? And is it effective at doing what they wanted to do? Can they engineer a short-term stimulus if they wanted to? So starting with monetary policy, do people at the Fed have an incentive to do the right thing, to do what we've called ideal monetary policy? Not necessarily, but as long as they're independent, then they don't have an incentive to do anything wildly bad either. And so while it's not ideal, right, we have to trust the goodness of people at the Fed and their competence, at least we don't have to trust them to override a whole bunch of bad incentives. Whereas for fiscal policy, we do. Right? It requires not only that we trust them to be good people in general, in the abstract, but also that we trust them to be good enough to overcome all those bad incentives. The incentives for re-election, the incentives to spend that money in ways that benefit them politically but don't necessarily help the economy or satisfy wants. Does the Fed have the knowledge to do ideal monetary policy? It has ways of trying to get that knowledge and ways of approximating it, but it's not in a competitive market. It's not subject to those profit and loss signals. So in general, the answer here would be no. Right? There's not generally the knowledge to know how to do ideal monetary policy. Same problem with fiscal policy. Right? Not only does fiscal policy not come with the incentive to spend the money efficiently, but even if they wanted to, right, there's not really the knowledge there anyway. And finally, is it effective? If you wanted to shift the volume of spending and have a short-term stimulus or recover from a recession, could you do it? Well, the answer with monetary policy is pretty clearly yes. Right? Monetary policy is a very powerful tool for doing exactly that. Whereas fiscal policy is really going to depend on how you fund it. Right? There's ways you can fund it that make it effective, and there's also ways you can fund it that make it not effective. So in conclusion, you can think of monetary policy as a very powerful tool that's difficult to wield well. Right? This kid has a snowblower, he's kind of small, and it's hard for him to aim it correctly. And maybe he just wants to annoy his sister anyway. Fiscal policy is going to be a sometimes useful tool, sometimes effective, but it's going to provide strong incentives not to do well. Right? The political incentives are going to be very contrary to efficient resource allocation. If any of you have seen The Lord of the Rings, right? The One Ring, it's kind of the same thing. Right? Very useful tool sometimes, but it corrupts you over time. It gives you incentives to not do well. So the takeaway of this unit is that the goal of stabilization policy should be to stabilize the volume of spending. And by stabilization policy, we mean monetary and fiscal policy together. And what's the best tool for stabilizing the volume of spending? If you have a fiat currency where your money's not a promise to anything, then monetary policy is going to be very much the most powerful tool. As we saw earlier, there's essentially unlimited ammo, so to speak, as long as your money's not a promise to anything. If you don't have a fiat currency, if you have something like a gold standard or a fixed exchange rate, where your money is a promise to something, monetary policy you're going to be a lot more constrained in. You're not going to be able to do as much of it, or any of it really. So what do you do if you don't have a fiat currency? What if your money is a promise to something? Well, we're going to talk about that in the next unit, when we talk about exchange rates and different kinds of exchange rate regimes. And that'll give us a way of thinking about why would you want your money to be a promise to something, and what are the consequences if you make it? What are the costs and the benefits of that? So that's about it for monetary and fiscal policy. Before next week, be sure to read chapter 20. That's going to be on international finance. And we'll pick that back up in the next lecture. Have a good afternoon, and I will see you then.